So if you're going to argue about who crashed the economy, I think it's far more reasonable to point the finger at Rachel Reeves than it is to Liz Truss.
Hello and welcome to Spectator TV. I'm Kate Andrews and I'm joined by the independent economist Julian Jessop. Julian, hi.
Hi, thank you.
Thanks for joining us. So Julian, the government started off the new year with a new host of problems, mainly the wrath of Elon Musk. But just because it has new problems doesn't mean that the old problems have gone away. And among the mudslinging that's been happening back and forth across the pond, there have been some pretty worrying indicators when it comes to borrowing costs. Can you tell us about these market jitters?
Yes, well, in short, there's a crisis in the bond market. So government bond yields, which are basically the cost of government borrowing, have shot up. They've been rising for a number of months now, but in the last few weeks, they've hit some important milestones. So, for example, the cost of very long-term borrowing for the UK government is now at its highest since something like 1998. So this is a very, very big move. And it's definitely something to worry about. I mean, not only, of course, is it the cost of borrowing for the government at a time when the budget is already under pressure, but it also sets the benchmark for lots of other forms of borrowing in the rest of the economy, in the private sector. So it's making it more expensive for companies and for households to borrow as well.
And gilt yields, whilst all very technical, did become somewhat of a household phrase over the past couple of years, really starting with the mini budget when they started to move quite dramatically and coming up to present day. Let's explain for some of our viewers who may not be as familiar, however, just how important this is and just how much it does impact our daily lives, because the cost of borrowing for the government has an impact on interest rates and what the Bank of England decides to do. It has an impact on what the government can spend. It has an impact on whether or not the chancellor is meeting her own fiscal rules. Can you speak a little bit about the real impact of what happens when borrowing costs start to spike?
Well, I can give you one particular number. So suppose that long-term interest rates, in other words, government bond yields, rise by 1%. So that's an increase from, say, 4% to 5%, which is roughly what we've seen so far this year. Then that will add close to £12 billion a year to government borrowing because of the increase in debt interest payments. Now, at the moment, there is headroom of about 12 billion a year in the government's forecasts. So basically, this increase in interest rates has wiped out any room for manoeuvre that the Chancellor might have on tax or spending. So if anything else goes wrong, or if interest rates continue to rise, then there's going to be yet another black hole in the public finances that has to be filled, whether that's through more tax increases or spending cuts or something else. So this is yet another reason to be concerned that the economy is already slowing, but we may still not have seen the full impact of tax rises because, in fact, there might have to be more to come.
And what is so painful is that these borrowing costs, these debt servicing payments, are paying off money that's already been spent, right? You don't get anything new for this money. You don't get new hospitals. You don't get more doctors or nurses. You're paying off what's being borrowed. And that makes it all the more painful as well, because when you talk about such staggering figures there, like £12 billion, when you think about what that could actually do in terms of public services or in terms of a tax cut, you could be taking a penny or more off income tax with that kind of money. Instead, it's just paying off what's already been spent.
Well, that's exactly right. If you look at it in other ways, the government has extended VAT to private school fees, which is supposed to raise, say, $2 billion to pay for extra teachers in the state sector. I mean, lots of question marks about those numbers, but that's $2 billion for more teachers in state schools compared to $12 billion that we're having to pay out potentially in higher debt interest, and that debt interest is basically lost. Obviously, it's great if you're a holder of a government bond who's getting more interest than before, but those are not necessarily the people we want to be helping at the moment.
Right. That context is so important, I think, for the conversation that we're about to have. So let's pull up some of those graphs here. We have the long-term borrowing cost, as you said, reaching levels not seen since 1998. But we also see here on the 10-year gilt yields, those have now surpassed the peak of where they landed after the Liz Truss mini budget. Now, Julian, you were advising the former Prime Minister during the leadership election in the lead up to when she became Prime Minister. You have written for the Spectator and elsewhere that you were not a part of the decisions that were made after. But one of the crucial breaking points really for Liz Truss was the fact that after she announced that mini budget, investors looked at it and thought, gosh, we're not terribly confident about this. We're going to demand a higher return if we're going to invest in the UK. Is the same thing happening now? Is it a fair comparison to make?
Well, I think it's a good comparison to make, in that there are some similarities and some differences. I mean, the obvious similarity is that yields have risen very sharply, and I think both the mini budget in 2022 and Rachel Reeves' more recent budget have played a part in that. On the plus side for Liz Truss, the budget, her mini budget, actually went quite well with businesses. Businesses welcomed it because it included tax cuts, including cuts in corporation tax. So that budget was, potentially good for the economy, whereas I think most people accept that this budget, in the short term at least, is having a negative effect. So if you're going to argue about who crashed the economy, I think it's far more reasonable to point the finger at Rachel Reeves than it is to Liz Truss. On the other side, the rise in bond yields in the wake of the mini budget in 2022 was much more abrupt. It was much more disruptive, and the mortgage market in particular was hit very hard. But even that, wasn't really just down to Liz Truss. There's also the problem that the technical problem in the bond market to do with what's called liability-driven investment strategies. Very, very complicated, but basically there was a ticking time bomb waiting to go off. And I think that's more the fault of the regulators, particularly the Bank of England, than it was Liz Truss herself. So there are some similarities and some differences. But if I were Liz Truss now, and I know she is actually doing this, she'd be quite rightly saying, well, look, you're accusing me of crashing the economy in 2022. But in many ways, things are actually a lot worse now. Interest rates are higher, and the economy is actually weakening sharply.
There will be some viewers who will listen to you saying that the mini budget was arguably better for the economy, who will very much disagree. Perhaps one of the fair comparisons to make, which doesn't reflect terribly well on Liz Truss or what this Labour government has done in its first budget, is that it is clearly not a great time to be asking the markets to borrow tens of billions more pounds, and yet both governments are attempting to do it. And there has been serious pushback in both cases, and that pushback translates to tougher times for voters.
If you enjoy what we do here at Spectator TV, then why not subscribe to the magazine as well? If you subscribe today, you'll get 12 weeks for just £12, plus a free £20 John Lewis and Waitrose gift card. You can sign up at spectator.co.uk/TV offer.
Yes, and I think it's important to stress here that this is a global phenomenon. It's not just in the UK that bond yields are rising sharply. They're also rising sharply in the US. In the US, for example, long-term government bond yields are now basically their highest since 2008, which was the global financial crisis. So this is happening in many places. To some extent, it's just a return of interest rates towards more sort of normal and healthy levels. So this was something that was going to happen at some point. But it has happened a bit sooner than most people expected. And that's partly because of worries about the enormous amount of government debt that investors are going to be expected to buy. So obviously they're demanding a higher interest rate to take on all that new issuance that's coming on the pipeline. But it's also new concerns about inflation. And the US actually is arguably a bigger problem here in many ways than the UK, because we've got the Trump presidency 2.0 coming soon. He is planning to, cut taxes, borrow more money, impose tariffs on imports, lots of things that might be inflationary and mean that the US budget deficit remains very high. So that is also therefore having a spillover effect in other countries. If you look at UK and US government bond yields, they're now tracking each other very, very closely. The difference, though, of course, is that the US economy is strong, ours is weak. So we should really have interest rates that are closer to the levels in the Eurozone, where economies are also struggling, rather than those in the US. So there's definitely something local happening in the UK too. And that's where essentially the fallout from the budget.
Yeah, I did see that you had written on X that Donald Trump is arguably just as much to blame as Rachel Reeves for this bond market jitter. I wonder, the US, for plenty of reasons, including the fact that it's the reserve currency, can get away with borrowing a lot more. But this is really the crux of it, isn't it? That from Liz Truss to this new Labour government, nobody really wants to deal with the spending side of the ledger. Liz Truss and Kwasi Kwarteng said that's to come. You're going to see the fiscal prudence down the line. Labor have suggested you're going to see it in the spending review, that is also to come. I guess the main difference, perhaps the reason that this has been sort of a longer process for Labor to see this rise in borrowing costs, is partially that they did implement such significant tax hikes. It was a signal, a very painful signal, to the market that they were going to try to account for some of this money that they wanted to spend. Liz Truss, of course, was cutting tax at the same time that she was asking to borrow so much money. But is the issue here just that markets have realized post-COVID, when we had this huge spending spree across the world, nobody really wants to change their habits?
Yes, I mean, you can probably get away with what governments are doing now if debt was, say, 60% of national income, which used to be considered a sort of a reasonable threshold. But in most countries, including the UK and also the US, debt is close to or above 100% of national income. So we're starting from a point where debt is already very high. On top of that, the state has got more involved in the economy in all sorts of ways, and Labour seems to be keen on doing even more of this in areas like labour markets and education and energy policy and so on. So the state is already very big, and the Labour government is planning to make it even bigger. I mean, one way to look at this, if you go back to the budget, then broadly speaking, the plan was to transfer another 2% of national income from the private sector to the public sector. And that was in the form of about 1% worth of tax increases and about a 1% increase in borrowing, which largely comes from future taxpayers, as you suggested earlier. So that's another big shift away from the private sector to the public sector at a time when the tax burden is already at a record high and when productivity, particularly in public services, is relatively low. So that was bound to disrupt the economy and unsettle the markets. In terms of specific concerns, investors in bond markets are worried about a number of things. One is that all that increased spending is just going to add to inflation, and therefore the Bank of England will be slower to cut interest rates than it otherwise have been. There also worries that those big increases in tax are going to slow the economy, potentially even cause a recession. So you don't end up raising anywhere near as much tax revenue as anticipated, and therefore taxes have to go up again. And finally, there's the sort of increase in borrowing, as you say, at a time when investors around the world are already having to buy a lot of government bonds. Here's even more that they're going to have to buy in order to fund big increases in public investment in the UK. So I think it isn't just the global backdrop. There's definitely big upward pressure on bond yields coming from the budget decisions as well.
Julian, I want to pick you up on this point about inflation because it is a terrifying prospect that we could be looking at another price spiral, especially after what happened post-COVID over the last few years. Nobody seems to be predicting that anything like that would happen again. But it doesn't take inflation ticking up much for the Bank of England to start making different decisions about whether or not they're going to cut interest rates. It could still have quite an impact. And if inflation ticks up, that leads us closer and closer to that dreaded word stagnation, where you don't have an economy that's growing, you have inflation higher than you'd like it to be, and very worryingly, you might have rising unemployment. Now, that last point is something that the UK has actually been able to avoid for a very, very long time, but you think there might be some factors that could see that number start to tick up.
Yes, well, I like to try and be optimistic, so I'll start with a few positive points.
Great.
First of all, I don't think inflation is actually going to rise very far. I think it will peak maybe actually slightly below 3% in the early part of this year. So remember, inflation was in double digits, more than 10% during the worst of the energy crisis in particular. So I don't think inflation is going to rise much further. I also think that over the next year or so, incomes are still likely to rise more quickly than prices. So most households are still going to see an increase in their purchasing power, even if inflation picks up. And then finally, as far as the Bank of England is concerned, they have actually signalled that they might be willing to continue cutting rates, even if inflation picks up, because they are getting more concerned about the downside risks to growth than they are about a temporary pickup in inflation. So I think there are some reasons to be optimistic. My worry, though, as you implied, was what's happening in the labour market. The labour market has definitely started to cool. So part of the fallout from the budget is that companies are much more worried about the outlook for the economy, but they're also freezing hiring and in some cases looking at making job cuts. Remember, they've been hit not just by the increase in employers' national insurance, but also many companies, particularly in sectors like retail and hospitality, are going to have to pay much higher wages from April this year as a result of the big increase in the national minimum wage. So the labour market is definitely cooling. Again, that might have a silver lining that it makes it more likely the Bank of England will keep cutting interest rates. But I think we will see a steady rise in unemployment over the course of this year. You're right also to refer to stagflation. So that's the sort of toxic combination of weak or falling activity, rising inflation, and higher unemployment. I think we will see that, but it'll be relatively mild compared to what we've had before. So back in the 1970s, we had a deep recession, inflation of 10% or more, unemployment of close to 10% as well. I think what we'll see this time is a shallow recession, a modest pickup in inflation, and a relatively small rise in unemployment. So it's what I call stagflation light. But that's far short of what's needed to repair the public finances. So the Office for Budget Responsibility was assuming 2% growth this year. I think we'll be lucky to get 1%. We might even get slower growth this year than we got over 2024 as a whole. So stagflation light is not a disaster, but it's still much weaker than what we need.
And let's pull up the growth chart, the forecast from the Office for Budget Responsibility that they published alongside the budget. As you just said there, Julian, you are not personally expecting for all of these figures to be met. In fact, the UK could really underwhelm, and you're not the only economist saying that at the moment. And I just wonder the extent to which you think growth is really at the heart of every issue in the UK right now. Yes, there are major problems. The size of the national debt, the regulation strangulation of building more homes. There are plenty of things that need to be addressed. But if you had robust growth in the UK, a lot of these issues would become easier, and some of them could borderline disappear. I mean, to what extent is the stagnation in terms of economic growth really what's holding Britain back?
Well, making the comparison again here between Liz Truss and Rachel Reeves. So Liz Truss made the mistake of announcing big cuts in tax before she had really addressed the spending side or made the structural reforms that are necessary to boost growth. One thing, though, that she could have done worse than that was to raise tax before making the spending cuts and before doing the structural reforms. And that's the bigger mistake that I think that Rachel Reeves has made. So the economy already wasn't looking great before Labour took over, but the first thing that Labour has done is to knock it to the floor. Business confidence in particular has tanked in the wake of the budget. So we're starting from a very poor position. If there is hope, it does lie in structural reform. And to be fair, Rachel Reeves has talked a good talk here about things like planning reform and fixing the pension system and more infrastructure spending, deregulation in some areas, tackling the crisis in the NHS, those sorts of things. So they certainly made lots of the right noises, but if you sort of dig beyond the headlines, the progress has been slow. The plan to fix the NHS is faltering. Planning reforms are still running into loads and loads of NIMBYism. There's questions about whether construction firms actually have the workers or the materials to build 1.5 million houses. And in lots of areas, of course, the new government is planning to increase regulation, particularly in the labour market, not just the big increase in national minimum wage, but also employment rights, which are great for people who do keep their job, but more rights mean more obligations. And as a result, employers may be less willing to hire. So we've got mixed signals at the moment, and the government doesn't really have the confidence of the markets here. The markets don't really trust the long-term growth agenda. So they're worried that all we're seeing is tax increases leading to the dreaded doom loop of a weaker economy, falling confidence, rising borrowing costs, more tax increases, and they'll start all over again.
Well, there have been whispers, or frankly something louder than a whisper, about the possibility that Labour will have to do another round of significant tax hikes if borrowing costs even just stay where they are now, but certainly if they keep rising and if growth remains really unremarkable, nothing to write home about. unless they are willing to slash a lot of public spending, and we haven't seen evidence of that yet, that last lever that Rachel Reeves might have to pull is another tax hike. She has been rather insistent that she doesn't want to or won't, but that hasn't been the message from the rest of the Labour government.
Well, first thing, I think that Rachel Reeves' comments here have essentially zero credibility. In the run up to the election, she was saying that there was no need to raise taxes, and then when she did raise taxes, she tried to claim that employers' national insurance somehow isn't a tax on workers. So I think she has very little credibility here. The second point, though, to make is that I don't think tax increases are guaranteed. Remember that the way that the budget works is it all really depends on what the Office of Budget Responsibility is assuming is going to happen in the fifth year of the forecast horizon. So you can actually have quite a lot of bad news in, say, years 1 and 2, as long as the OBR is more optimistic about what happens at the end of that period. And it's possible, for example, that the OBR might start to say something like, well, there's been this big increase in public investment, and that will have a bigger impact on growth than we anticipated. Now we know a bit more about the detail of it. So I wouldn't say that tax increases are baked in. But I do think they're more likely than not. I think that's clearly the way that we're heading, given the weakness of growth and other pressures, including higher interest rates. So the question is, where will the axe fall? I suspect that there will be another round of tax increases, probably focused on getting rid of some more of the sort of tax reliefs and exemptions, for example, on pensions that so far haven't been touched. But there are a few other things the government might do that would be less painful. I think one thing they will be looking at is reducing the amount of interest that the Bank of England has to pay to commercial banks on the reserves that have been created over the last few years as part of quantitative easing. You could probably save, 10 to 20 billion a year, either by reducing that interest rate or imposing some sort of tax on the banks. That won't be painless because that tax will be passed on to borrowers in one form or another, but that might be preferable to some of the alternatives, including further increases in, for example, employers' national insurance or other things that they might do on personal taxes.
Well, Julian, let me end by asking you whether or not you think the economy is crashing this week. That has been the phrase that has been levied at the Liz Truss administration, and that Labour very much liked to use during the campaign, and now that the economy crashed when borrowing costs started to surge and when the forecast for interest rates also started to surge. Now that we have come parallel or actually surpassed borrowing costs since Labour's first budget, is the economy crashing, or is that completely the wrong way to talk about what's really going on?
No, I think it's fair in this case. I think you can say the economy is crashing in two ways. I mean, first of all, growth has collapsed. In the first half of last year, growth was pretty strong. We were pretty much at the top of the league table for growth amongst the G7 group of advanced economies. But by the end of last year, we're going to be pretty much at the bottom. So, other economies are slowing, particularly Germany and France. But, our turnaround has been much more dramatic. And undoubtedly, that's at least partly a result of what the government has done on the budget and other things. The other sense in which you can say the economy is crashing is if you look at business confidence, which has plummeted over the summer, but particularly since the budget. So businesses are much more worried about the outlook for the economy than they were before.
Consumer confidence was not terribly high after the mini budget, and when people were seeing what was going to happen to their mortgages. Are we slightly at risk of cherry picking this phrase when it suits? I mean, I wonder if the real wake up call here is the national debt and the fact that you're looking at so many problems down the line if you can't get your spending and your borrowing under control. In both circumstances, perhaps that could be highlighted, and it's still the topic nobody wants to talk about.
Well, that's right. I mean, it's rather worrying to think that we've got the budget behind us, but that's only part of what Labour's going to have to do to fix the public finances. They also need to have this big spending review, which is going to take place over the spring. And rather like with tax, they sort of tied their hands by saying that, no, we're not going to raise certain taxes, which forced them to make even bigger increases in others. With spending, they've protected certain budgets. So they promised all this extra money to the NHS with no real certainty that's going to produce an improvement in the quality of services being delivered. But in protecting the NHS and certain other departments, they're putting the squeeze on so-called unprotected budgets. And those are some areas where, even me as a sort of, small state free marketeer, I would be worried. So these are things like the criminal justice system and defence, things that, can't really be left to the markets to sort out, where the government has to be active. And I don't think we can afford to cut any more from criminal justice. And if anything, we should be increasing the defence budget. So we've had one shoe land, which has been the budget with the tax increases in that. But there's potentially another, which is a tough spending review with some very difficult choices in it that may not end up being the right ones.
Julian, thank you so much for joining Spectator TV. We look forward to hosting you again.
Thank you.